Thanks for joining us for the latest episode of Financial Longevity, the Merlin Wealth Management educational podcast. In each episode, Michael Merlin, founder of Merlin Wealth Management, along with various experts, breaks down complex financial topics to help you increase your wealth span and gain the confidence to enjoy your bigger future. For more information about Merlin Wealth Management, please visit our website at rocco.com/Merlin. You can also find Michael's book, Financial Longevity, on Amazon, Audible, or wherever books are sold. And with that, here's founder of Merlin Wealth Management, Michael Merlin.
Thanks, Tom, and welcome everyone to 2026 and the Financial Longevity Podcast. As always, I'm your host, Michael Merlin, and today we are kicking off our first episode of 2026, and we're diving into, I would say, one of the most debated topics in investing, active versus passive management. I think you can certainly, whether you agree or not with how debated it is, you can certainly say that it's controversial or difficult to kind of come to a conclusion on the topic, considering that Warren Buffett, who obviously is considered one of the greatest investors of all time, was probably the most famous or is the most famous active investor, but tells everybody else to be a passive investor. So if you were confused about it, there's obviously good reason when you're seeing things like that. But we'll dive into how the strategies differ, how they perform in various market environments, and specifically how our clients, ultra high net worth investors in particular, should the things they should consider when looking at active versus passive strategies and performance. But before we jump into the discussion today, I'm really excited to introduce our guest. My good friend Casey Clark is the president and chief investment officer of Rockefeller Asset Management. He leads the firm's investment strategies and oversees a team of dedicated folks that deliver innovative solutions to clients. Casey has extensive experience in portfolio management and in sustainable investing, and Casey has been instrumental in shaping Rockefeller's approach to combining performance with purpose. So today we're really excited to tap Casey's wealth of investment knowledge so that we can discuss active and passive strategies and the impact that they have for long-term investors. So Casey, welcome, and really glad to have you here today.
Yeah, thank you, Michael. Looking forward to it.
Awesome. So let's start out really simple. Would you mind explaining to folks, or just defining, I guess, pretty simply, the difference between active and passive management so that our listeners are kind of up to speed with what we're going to be talking about today, and what are the core principles behind each approach?
Yeah, and while everything sounds simple, the complexity underneath can go and go. So I'll just try to keep it right.
Yeah, sure.
So active, right? Think investors, pick specific stock, bonds, private companies, commodities, just assets. Pick assets they believe will outperform the broader market and generate a desired return. The goals here could be, yes, excess returns. That's what everyone talks about. Better risk management, tax optimization, or specialized exposure. People often refer to that as thematic investing. So do you want exposure to tech, healthcare, decarbonization, demographics, right? So when we think of active, think you're picking stock, bonds, private companies, commodities, just assets with the goal of outperforming, but also risk management, tax optimization, specialized exposure, right? Passive is more rules-based. It's where you want to own the market. Nobody's actively researching a company or the underlying investments. The goal most of the time is just market returns, not to beat the market. Now, the most common rules-based passive index is market cap weighted, right? The S&P 500. The weight of the stock in that index depends on the size of the company. But you can also have passive strategies, which we may not get into as much, that are equally weighted or factor weighted. Now, unless indices use precisely the same methodology, one thing I just want to point out is the returns could differ, and sometimes significantly. And the index methodology, just rules or criteria, they govern how that's creative. It's almost, think about it as 100% automated with kind of some board oversight. So understanding the methodology and the impact it have on performance is important. They can be complex, but they're fully transparent. So when you think of passive, there's a whole world. You get an entire podcast on what is a passive strategy, but for the most part, think rules-based but transparent.
So just to kind of dive a little deeper into that,
yep.
From a layperson's perspective,
yep.
a passive strategy is basically going to do the best it can to mimic the performance of the index. So an S&P 500 index fund is going to try to be as close to the performance of the S&P 500, maybe minus a few fees, or as you said, whether it's market weighted or cap weighted or whatever the case may be. But it's trying to mimic both the performance and the behavior of the index. So for example, if on April 2nd, last year, when Donald Trump announced Liberation Day and the S&P fell, 12% in the month of April, an S&P passive index fund is going to go down 12% in the month of April, or something pretty close to that, considering that it is not the job of a passive investor to say, oh boy, there's a war, or there's something that's changed in the world, and we should go 50% in cash to try to save the investors on the downside. That's not the thesis behind passive investment. Passive investment is basically put it in a drawer, lock it away. If it goes down 50%, fine. If it'll come back, so on and so forth. But over a longer period of time, you're going to achieve a return equal to whatever the underlying index is. Is that
exactly
correct?
Right? Exactly right.
So then on the flip side, for an active investor, right? So and someone who prefers active management is looking for a couple of things, right? Number one, they may be looking for some ideological clarity, right? There's 500 stocks in the S&P, and they may not like 400 of them for various reasons, right? They don't like that they are over levered, or that they, invest in things that, are bad for the environment, or whatever the case may be. And so they want to pick a smaller pool of more transparent investments where they can basically say, I'm going to pick and choose these things. And for those reasons, I may outperform the index, I may underperform the index, but I would rather have a smaller grouping or a more concentrated grouping of individual names than just to try to own the entire market.
Exactly right. Yep.
Okay. So if that's the landscape, then do you see how that these strategies behave differently in different market environments? I mean, I think over the last couple of years, where there seems to have been a lot less attention paid to valuation and fundamentals, et cetera, and the market's just kind of done kind of a straight line up. That's probably a better environment for passive investment versus choppier markets, maybe like we had during COVID and whatnot, where active management may have done a little bit better. How do you see that?
Yeah, so active managers like to say they can be more nimble in down markets. They can manage risk, and some can, right? Some can. It's not easy, but some can. You have to be right two ways: one on the exit, and both, re-entering the position. So good active managers can be a little more nimble in volatile markets. So in markets that are just momentum driven, or everything is going up into the right, driven by large cap stocks, harder to outperform, more volatile markets should start to see the benefit of active management. Of course, people don't like this answer, but it really depends when you talk about performance across market cycles. And one of the things that we like to think about in active management is, how do we have a consistent and repeatable return stream? Yes, that we think we're going to outperform, but consistent, repeatable return stream. So one example is you could have a high quality small cap strategy. Now, typical high quality stocks, what is a high quality stocks? Think about stocks that are generating profitability with low leverage. So levered, they're not taking on a lot of debt, and they're profitable companies. So those are broadly, think about those as high quality companies, just to oversimplify. Now, those strategies, typically the goal is protect on the downside, so outperform when markets are down, and then participate on the upside. So protect and participate. And so they may have what we call upside downside captures, of capturing 90 to 100% of the upside. So when the market's up 10%, they may be up 10%. They may not outperform. When the market's down 10, they only want to capture 80% of that. They may be down 8. And over 3 to 5 years, you get outperformance. And so to your point, the performance across market cycles, one hand, it's easy to say volatile markets, active management should perform. When markets are up and to the right, could be a little more of a challenge.
Absolutely. And just to add on to that, obviously, your team at Rockefeller Asset Management is a primarily active manager, and us at Merlin Wealth Management, we also manage our own 5 independent strategies, and those strategies are also active management. And one of the things we talk about a lot, in our asset management meetings and conversations, is risk adjusted return, right? So
exactly right.
To your point now, the ownership of quality companies, however you define that, right, should in theory make your portfolio less volatile than an underlying index that may own a whole bunch of different things with higher betas, i.e. higher risk factors, et cetera,
Yep.
right? So whereas the S&P may go up 10% in a momentum driven market, and an active manager with high quality bias may only go up 8%. But if you look at the standard deviation of those portfolios, right, the standard deviation of the active portfolio could be significantly lower, meaning that you only got 80% of the upside, but you did it by taking a lot less risk. And I think that's a really crucial point for investors to understand. So could you talk a little bit about that?
Yeah, well, one point I want to highlight with this too is I think what you're getting at with risk. We are at a time unlike any other time in history in the past 35 years. People say that. I seldom say that. A lot of people are like, this is the all time. No, we are at a time unlike any other time in history. You have the emergence of these hyper profitable mega cap tech companies with low capital intensity, meaning they're not investing in physical assets, low capital intensity. They have changed the rules. They have made outperforming large cap benchmarks a little harder to beat, but also added a level of concentration risk that people aren't talking about. And so, let me just some stats. If you look at what are the top 10 stocks in the S&P 500, top 10 stocks, those make up 40% of the benchmark. Over the past 35 years, that's an all-time high. That is 2 times the average over the past 35 years. So 5 or 10 years ago, if you invested in the S&P, the top 10 stocks may have been 20% of the benchmark. Now it's 40. Not only that, looking at a different way, if you just think of tech stocks, which I'll define as, just to keep it simple, broadly tech stocks, how they're defined, it's roughly 50% of the benchmark. Again, 2 times the median over the past 35 years. And so you, who world-class financial advisor, if you would call a client and say, hey, I want to put a meaningful portion of your assets, U.S. large cap equities, in 50% tech, and these top 10 names are going to be 40% of your portfolio, there should be some apprehension there. Someone should ask questions about that. So we are in a very unique environment, which is making, I think, active management more important, of layering in potentially large cap that don't own the top 10, or allocating a little more to small cap, or to international equities, or to other strategies that we'll talk about. But it's just such an important point from a risk management perspective that past performance is not indicative of future returns. And we're at a moment now where there's more risk in a passive portfolio, I think, than many understand. As you know, we call that concentration risk, to break it down, just the risk of highly concentrated names in a portfolio.
Absolutely. We did once a quarter, David North, the head of MWM Asset Management, and I do a kind of an update podcast for markets and whatnot. And the last one we did at the end of last year, we talked about this exact subject. We talked about the fact that you're seeing a lot of things that can cause concern, yet if you're acting on those concerns, right, you're underperforming the market, right? Because that same nucleus of 10 stocks, 7 stocks, whatever you want to call it, continues to outperform regardless of valuation, regardless of concentration, regardless of anything, right? So, but what's interesting, right, is that, when you see the concentration of those names, and you also see that on top of those names, the other outperforming names in the benchmarks are starting to become, the names like that have no revenue or no earnings or things along those lines. When you start to get down to, the fundamentals that we look at, I know that you look at as well within Rockefeller Asset Management, the things that you look at to define a good investment, whether those are valuation metrics like EV, enterprise value to EBITDA, or whatever numbers you use, right? Anything that's attractive by those measurements is not performing well. Anything that's momentum driven or theme driven, AI, etc., that's doing well, right? And so underneath all of that, to your point, there is a cadre of industries and stocks that are cheap. Whether it's small cap name, high quality small cap names, whether it's some cyclical or industrial names, you've got some names that are very, very attractively priced, but nobody's talking about those names, because if you strip out the performance of those 10, right, the performance of those names over the course of the last year has been like 5 to 7%, right? Nobody's excited about it, right?
Yeah.
I think it drives toward one really important point that, again, Warren Buffett, who I'll refer to a couple of times during our chat. Warren Buffett even though he warded most amateur investors away from active management for obvious reasons, one thing he did say about successful active management is that you have to be willing to sustain some quarters or even some years of underperformance in order to get long-term outperformance, right? And it's because you have to take advantage of anomalies like what we're seeing today and position your portfolio in a way that probably isn't popular, right? That probably isn't going to necessarily take advantage of what's working today in the market in order to get consistent long-term returns, like you mentioned. Do you agree with that?
Exactly right. One of my mantras is that people lose more money trying to predict the next recession than just staying invested and being disciplined.
Yeah.
And you, just as a phenomenal advisor, know this. Part of our job is just to keep people disciplined, keep them invested, understand what their time horizon, cash need, risk tolerance. Don't push them to uncomfortable levels of risk, because when people get pushed to uncomfortable levels of risk, when things get choppy, they lose discipline and they say, just sell. And that normally is at the wrong time, right? Selling on the downside or just waiting for the next. People have been waiting for the next recession for the past 5 years, have lost a lot of money. I mean, markets were up, 20 to 25% 2023, 20 to 25% 2024, 15% 2025. So waiting for the next recession is people lose more money doing that. And just to your point of staying disciplined, active management around consistent return streams. And again, we're both, active managers. It doesn't mean there's not a place for passive though. I do think, like you agree, I know we talked about this before, in asset allocation, there's a place for active and passive. And part of my main message here is when you're just thinking about passive, you need to think about rounding out other passive strategies or active strategies to manage that risk. Because if there is a turn where the large stop getting larger, people are then going to realize the risk that was in the benchmark that was greater than years prior because of all the concentration.
Absolutely. And I think passive is a great tool. Again, going back to, you made a great point about allocation, right? Like, this isn't just about bottom up, picking the right names, holding them for a long time, seeing them compound, et cetera, right? The reason that the most valuable thing we can provide to a client is a sound allocation that lets them, stay the course, if you will, during times of turbulence, right? People say, oh my gosh, passive strategies are so cheap. How can you justify charging a client, 75 basis points, 100 basis points, whatever it is? If you look at the research, right, a lot of that value is earned and then some by a multiple, right? In tough times where behavioral economics kicks in, where people want to do the wrong thing based on emotion and just fear. And it's and if we've done our job correctly, right? If we've mitigated where risk can happen, especially for ultra high net worth investors who don't need to, exact every basis point of return out of the S&P and take every percentage point of risk that's involved in an index, because they don't need to necessarily make more money. They're just looking for a reasonable return. You should have all those things encapsulated in a proper asset allocation that keeps people from having to make those kind of, monumental decisions on a regular basis, right? That shouldn't be the case. Sure. You talk, you discuss, you say, like you said, is anything different this time? Do we stay the course? Is there something to change? But if the allocation is sound, if the planning is sound, that should not really be a bone of contention when things are choppy, right?
Exactly right. And when the allocation is sound and the planning is sound, and all sides, right? Because as you know, clients have various risk tolerance, they have various cash needs, different time horizons, different tax consequences. But if they're comfortable with the allocation, planning sound, asset allocation sound, it's easier to stay disciplined.
Absolutely.
And almost more important than active passive, because I do think in an allocation should be blended both, is just staying disciplined. Even active managers staying disciplined. If you're a high quality US small cap manager, be the best high quality US small cap manager. If you're a large cap growth manager investing in tech only, and you're saying, hey, Casey, I hear this, but I love the risk, like be a great large cap tech investor.
That's right. That's absolutely right. And again, I just think that some of the most successful investments we've made, take after the financial crisis, 2009, 2010, we overweighted equities in our client portfolios. That was an allocation decision that turned out to be one of the most successful investment decisions we made, not because we bought Apple or Amazon. Those were great decisions too, but the bigger, better decision was the overweighting of the asset class, not which stocks we bought within our strategies, right?
And so people, go on, sorry, cut you off.
No, go ahead.
I just people that nuance is lost on most. That a lot of returns are driven through asset allocation, right? Just to your point.
Absolutely. I going back to what you said about passive strategies. I think there is a huge benefit to passive strategies inside of an asset allocation in certain circumstances, right? Where a tactical allocation makes sense. For example, today everybody's talking about the energy space for lots of reasons, right? Do you like energy because of what's going on in Venezuela? Do you like energy because it's going to have to power huge data centers that are running AI? Like whatever reason. But if you as an active manager can't find an alpha or a differentiation between Chevron, Exxon, ConocoPhillips, Halliburton, Valero, whoever, you can go buy a high quality index that just is all those businesses, that's an industry itself, and put that into your allocation as a tactical bet, right? That is a huge tool that, as some of us know from, being in the business for 30 years, didn't exist,
exactly.
15 or 20 years ago.
Yep, exactly right. And just reinforcing your point, active managers need a differentiated edge that we believe is consistent and repeatable.
That's correct.
And if you as the advisor, you as the investor don't believe that, there are passive choices for many of these various exposures now.
That's right. And I think even a good active manager, and I think you would agree with this, even a good active manager, when you've done your research and you've kind of come onto a theme, right? If you can't find a way to express that theme through an alpha generating individual investment, there's nothing wrong with expressing it through using a high quality index to express that particular theme. So whether it's energy or, we have a large gold position right now, like, we bought an ETF, right? Like that, we weren't going to go buy bars and put them under the mattress or anything like that.
Yeah, exactly right.
Yeah. Fortunately, there's a tool like the ETF that we can go out and express that, that theme through an ETF. So let me ask you this question. We've talked, you've talked a lot about technology. Technology is forefront and center right now. One of those things that's out in front now, obviously, is AI, right? And I think all of us are using AI to some degree in our daily lives. I think it's helping. I think it's creating efficiencies. I think we have, aspirations and dreams for it to do a lot more things for us that will be, efficient, et cetera, et cetera. But you mentioned just a minute ago, I think one of the most important takeaways for successful active management, which is you have to have a durable edge. For the people on, for our listeners, what does that mean, right? That means that you feel like you have the ability to do some sort of research or gain some sort of analytics or some sort of information that gives you a slight edge in knowing how certain businesses perform versus, everybody else. And if you have that edge, it should give you a little bit more insight into deciding what, when a good time to buy a certain company is, or how long you should hold a certain company. Like that edge it needs to be durable. Do you believe that AI will erode the ability to find that edge? Or do you think AI will give people an ability to even have a more heightened edge? What's your inkling about that?
Yeah, no, I don't think it'll. First, I think AI is going to change the world. Use it like you. I'm as a big believer as anyone. From a market perspective, I'm bullish over the next 3 to 5 years, specifically because of AI. And I do think returns are going to move from the infrastructure, the names we all hear about every day, to the application of AI. And it's going to start it's going to be the people who can use it best and the companies who can use it best, which will increase margins, which will drive earnings, and ultimately over the long term, earnings drive markets. Which is why I think things like small cap, international equities is an asset class. AI is going to underpin an ongoing over the long term bull market, in my opinion. Now, to answer your question though about will it erode some efficiencies? Artificial intelligence is using publicly available information. This is something that I was talking about a lot. It's almost the same thing as quantitative investing, which uses, sophisticated firms have been doing this for a long time, where they're using publicly available information, feeding them into models that have reason and logic, and outputting buy or sells. So to me, while it's the level of sophistication is one up by magnitudes, it's a form of quantitative investing that is looking at publicly available information. Like all good technology, it should make your good investors better. That's what I believe. It should make your good investors better.
I couldn't agree with you more. Again, I think for a while, again, take our friend Warren Buffett. When he was in the early parts of his career, when information wasn't as free flowing, right, the ability to find a durable edge was even bigger, right, because a lot of people didn't even have information. They couldn't get a stock ticker, or they couldn't get an annual report. Now, obviously, all that information, to your point, is publicly available, but yet, there are several who still find edge or still find an edge in certain niches within the market. And to your point, part of the way to get that edge is a unbelievable amount of discipline and research and analytical work that has to happen in order for you to maintain the edge. And AI should be able to help facilitate that. Do you agree?
Well, with Warren Buffett, imagine Warren Buffett in his prime with AI. Would he be better or worse investor?
100% better.
You think you
wouldn't have to sit there and go through all those annual reports. He could have AI go through the annual reports for him.
Warren Buffett with AI is something that I wish we could all see. Yeah.
We should. Maybe that's the AI agent we should all create. Warren Buffett with AI.
There it is.
So before we wrap up, we got a few more minutes. I just wanted to ask you this. I really do think that there are three very important metrics for an active manager to be successful. You've hit on the most important one, right, which is the durable edge. The other one that I think is equally important is maintaining a long-term time horizon. And I think that a lot of people, a lot of proponents of passive management, feel that because active management can vary in performance on a relative basis versus benchmarks, that it's harder for people to stick with it, but therefore they'll stick with passive management because you're not touching it. I don't find that to be the case, right? If the market goes down 50% and you're in a passive index fund and your funds go down 50%, you are not sitting on your hands and just saying, "Oh, this was part of my strategy." We don't find that to be the case on our end, facing clients. What do you see from an institutional investment standpoint?
I think that the main difference from an institutional investor and an individual investor is the discipline. But where does that come from? It's not because individual investors are less sophisticated. It's when you're dealing with an institution and you have very smart people managing those allocations and managers. It's not their money.
Right.
It is not their money. They're not smarter than the individuals. It's just not their money. So it's less personal. Yeah. And you can be more academic, and it's easier to stay disciplined. When it's your money and the market's down 50% and your 401k goes from X to Y, you feel it, and you have a physical reaction to that. And people get a little more anxious. They get, the world's falling apart. I mean, look at COVID. I mean, that was, you mentioned, you mentioned 08, 09. I remember going risk on in COVID and talking to our team and just saying, look, at the moment of like greatest fear, when everyone thinks the world is going to end, like throughout history, that has been the time to invest. Like I am scared right now too, but geez, is the world going to end? Like now, and so I just think the difference between the institutions and individuals is that component. Not people like to say more sophisticated unless it's not the case. It's not their money. You can be more academic with it, which is another reason why advisors, they're so important, because they keep you disciplined. While the advisor's looking out for the best interest of the client, it's easier when it's not your money, and you can guide people better, and you can have a steady hand, and you can stay the course, which is something that you said, and I love that line. You can just stay the course.
I think that's so true. I'm gonna rattle off a couple statistics, because one of the things I really wish from an advisor standpoint, right, is we've gotten the financial services industry, the wealth management industry, has gotten into this habit of reviewing performance on a quarterly basis. We sit with our clients, we love to see them, we love to talk about things, that are going on in their lives, and, any sort of planning things we need to talk about, or strategic things we need to talk about. But no matter what, if we're sitting there, we're going to have to look at the performance of the portfolio versus some cadre of benchmarks, right? And I hate that. I wish we were only looking at the, if we've done significant planning for the client and we know that to achieve their goals, they need a risk adjusted return of 8 to 10% or 7 to 9% or whatever it is. All I care about is looking at that number over the course of years, right? Not over the course of quarters. So the numbers I want to share is Warren Buffett, right? Again, considered one of the greatest investors of all time. Warren Buffett underperformed the S&P 35% of calendar years, okay? And 53% of quarters, right? Yet over rolling 5-year periods, he outperformed the market 73% of the time.
Wow.
Right?
So more than half the quarters he underperformed.
More than half the quarters he underperformed, right? So if he was me, right, or if he was any advisor sitting with clients, right, on a quarterly basis, half the time he'd be sitting there, he'd be telling them they were underperforming.
Yeah.
And we know, from the conversation we just had about behavior and psychology, that when you sit with people and you tell them they're underperforming, their instinct is to want to change something, right? Yeah. That's the instinct. Buffett talks a lot about, inactivity bias, right? That he said famously in one of his letters, he would have been better off going to the movies than touching any of the stocks in the portfolio during the course of a year, right? I've quoted on this podcast before a study that was done with soccer goalies, that says that, the soccer goalie, if they're facing a penalty kick, will 100% of the time either move to the right or the left. They'll never just stay in the middle. But research shows that if they stayed in the middle, they'd be 33% more successful. If they
great.
But the inactivity makes it look like they're not trying, right?
Yeah,
So we all associate inactivity with not trying, when in a lot of cases, inactivity is the right solution.
Yeah, that's great. I love that anecdote.
So again, I think we've hit all the high points. Any parting thoughts?
Do you mind one thing that I wanted to talk about that I think people don't is there are attractive opportunities in asset classes that don't have investable benchmarks. There is no viable passive solution.
Sure.
Municipal high yield, private equity. For those that can invest in private equity, I do think there's going to be a disproportionate gains going to private investors, which is in the future. Long short equity. Right. And so there are areas that just don't have passive benchmark. Municipal high yield is one where that is not an investable benchmark. And so that's an area where we have mostly bonds that are made up of what are called project bonds. Right. And they typically finance things like retirement communities, charter schools, land projects, and they have tax exempt status. They're not general obligation bonds backed by the authority of a city or state, but they rely on revenues from specific projects. And some of them have implicit backing. Right. And it's such a fragmented market, and the liquidity and the structure of the market makes the benchmarks uninvestable. Meanwhile, you have tax exempt yields of 5.5%. I mean, that's nearly 10% taxable equivalent yields. And not everyone loves to talk about stocks and the benchmarks, but I don't think not enough people talk about municipal high yield or some of these areas that may not even have a passive benchmark, where if you can find a consistent, repeatable return stream that's tax advantage, and the tool that can be within an overall allocation.
Absolutely. Yeah, look, we said it, and I think it's a great takeaway, beyond just the differences between active and passive. But, the idea of a proper allocation, knowing where municipal high yield fits in a client portfolio, knowing where private equity fits, especially if you've done proper planning, if a client's already done their legacy planning and they've got a vehicle that's outside their estate, and you've got a great private equity deal that looks like it's going to have, a 20% IRR. It's a great place. It's a great place to put that. If the client has income needs and is in a high tax bracket, that's how I started out in this business, was as a municipal bond portfolio manager, if you will. And so, that's 99% of what I did when I started out, was I managed a portfolio of municipal bonds. So, back then, not to date myself, but back then, investment grade municipal bonds paid 5%. So you didn't even have to buy high yield. But again, I think the idea of having a proper allocation, is super important, beyond whether you decide to express your equity fixed income allocations through active or passive management. It's getting the top down piece right first that matters, a great deal.
Yeah. And I knew I liked you for a reason. I started off in fixed income. And bond people think differently. And
that's right.
And don't bet against bond investors. So I didn't know that. I also started in municipals.
I always say that the best stock investors are bond investors.
Yes, exactly right idea.
I think that 100%.
Yeah.
I don't want to jip our readers, our listeners, because I did mention that there were three things that defined successful active management. And we talked about durable edge, and we talked about long time horizons and being willing to look through, a couple of quarters of underperformance or several quarters of underperformance for long-term outperformance. But the third thing, and I know you agree with this too, and you kind of mentioned it just now about investable versus non-investable. The third thing is really, when you find conviction around an idea, you have to buy a relatively large position, right? Like we don't own in our, on average across our three equity strategies, we own about 25 to 28 stocks within each strategy, right? So if you own all three strategies, you own somewhere between, 70 and 80 stocks. Like that is not 3,000 stocks. That's not 5,000 stocks. That's not 500 stocks, right? So, to have outperformance over a long-term period with active management, you do have to concentrate to some extent. You don't want the kind of concentration that you talked about in the benchmark. You don't want, 50% of your names in tech or whatever the case may be. But when you find a name and you have conviction around that name, you've got to, invest a significant amount in it to achieve that alpha that you're looking for.
Yep. I like that. Durable edge, long-term, high conviction.
Those are the three things. So look, with that, Casey, I really thank you for your time and for sharing your insights on this really fun topic to talk about. For our listeners, I just want everybody to remember that, as we've been talking about over and over again today, the right strategy depends on your goals, your risk tolerance, your time horizon, getting that top-down asset allocation correct. If you enjoyed today's discussion, as I hope you do for all of ours, please subscribe to the Financial Longevity Podcast, available on Apple and Spotify. And please join us next time as we continue exploring strategies to help you achieve lasting financial success. Thanks so much.
Thanks for listening to this episode of Financial Longevity, the Merlin Wealth Management Educational Podcast. To learn more about Merlin Wealth Management, visit our website at rocco.com/Merlin. This material was prepared by Rockefeller Capital Management. The views expressed of the host and guests in this episode are as of a particular point in time and are subject to change without notice. The views expressed by the speakers are solely their own and may differ from or conflict with those of other divisions in Rockefeller Capital Management. This information was provided for illustrative and educational purposes only. From time to time, we may mention specific securities or investment strategies where we have an active position on behalf of ourselves and/or our clients. Any mentions of a specific security or company is purely casual and should not be construed as an investment recommendation, investment advice, an offer of Rockefeller investment advisory or brokerage services, or a projection or illustration of the performance of any particular investment or strategy offered by Rockefeller. Investing involves risk, including the potential loss of principal. Before making any investment decisions, listeners should conduct their own research and consult with a qualified financial advisor to ensure that any investment is appropriate for their individual circumstances. Forward-looking statements, including those presented herein, are inherently uncertain, as future events may differ materially from those reflected, and past performance is not a guarantee of future performance.